So basically, we're going to do a pretty good analysis on basically this list that we created. Okay, so first of all, starting off with the comparable analysis. Now this is where we use the mergers and the acquisition, the acquirer and the target. What company are we buying? So this is called a precedent analysis sheet where you go through it. So think of it like the precedent trying to acquire a bunch of different companies, right? Precedent analysis sheet, right? So this is where you have the enterprise value, the market capitalization. So enterprise value, what else? The EBITDA, the EBIT, which is earnings before interest and taxes, EBITDA, which is earnings before interest, taxes, depreciation, and amortization, and overall we have price to earnings ratio, which is obviously like total price of the stock compared to how much you really make as a ratio. And we also have what else? Yeah, so overall everything, the common factor that you guys need to know is that in most of these equations, it's always the final outcome over the initial outcome times a certain amount or as a ratio. For example, now let's say enterprise value, right? Enterprise value is calculated as, so it's also known as TEV, which is total enterprise value. It's the same thing basically, but basically when it comes to enterprise value, it's basically the market capitalization, right? Market capitalization plus the debt minus the cash, right? So for example, market capitalization is the overall money that's flowing within the company. This is calculated in the form of the share price times the total number of outstanding holders. That means including public and the private. So that combined with the total enterprise value. So that's the market capitalization plus the debt minus the cash that's pulled out from the company or from other sources from the company. So that equals to the total enterprise value. So moving on, we have assets. So like I said, assets and to inventory, like inventory and assets turnover, right? So this inventory and assets turnover, this happens in a very common equation. This is, like I said, I'm referring back to the original equation that I was saying, which is the final outcome over the initial outcome. So in this case, it will be the number of sales, total number of sales over the average assets the company has. That's called asset turnover, and the exact same thing but applied for inventory is of course inventory turnover. And then exactly, so see, final outcome over initial stuff explains most of these equations. Now value at risk, okay, that's what we stands for. Now net total gross average, you know what it means. Net means full. That means full as in like after calculating for the costs that need to be going away. That's also referring to this one thing called accounts payable and receivables. Payable means you need to pay them, and then receivable means you need to receive that money, which is part of accounting, right? So yeah, basically the total and the gross is like gross. Gross is obviously like per product or service or on average. So earnings per share, so this is total minus dividends. So dividends is how much, so total making, and then dividends is of course how much you pay away divided by the I don't know what, I have a confusion here, but we'll get back to this. So weighted average cost of capital is of course the how much money the company spends on financing its assets and pretty much keeping the company alive. So that's what weighted average cost of capital means. And we have, again, I've explained this, value at risk based off stats. Now this is very closely related to standard deviation. If you guys have heard of keeping things as close to the mean as much as possible. So you check the left side and the right side to calculate the negative side of risk and the positive side of risk. So yeah, that's that. Earnings per share, so compound annual growth rate, so that's just the future value over the present value to the power 1 to the power 1 minus n. Okay, 1 minus n, sorry, 1 divided by n minus 1. Okay, that's the equation that I'm just starting to get familiar with. So internal rate of return and present value, the difference between, okay, so there's a common equation that keeps repeating across many of these equations, and that's 1 plus r times n. Okay, 1 plus r times n repeats across multiple different equations. The first one predominant, I don't know how to pronounce it, but basically the discounted cash flow, the future value, the present value, of course, like the future value is calculated present value times 1 plus r times n, but then the future value is quite the opposite. So it's the present value over the present value is quite the opposite, so it's the future value over 1 plus r times n. So the same way you add initial investment into that idea, so now you get internal rate of return and net present value, which go closely hand in hand. So yeah, that's weighted average. So that's these two. Where was it? Right here. Okay, so outstanding means public and private holders. Okay, in the case of finance, outstanding means public and private both combined. So market capitalization, I've explained what this equation is. So of course the price of the share times the total number of outstanding shareholders. So this includes public and private. So private equity from the private side and public from public, that's the IPO, initial public offering. In other words, what's part of the stock market, right? In share markets. That's basically the public offering. So both of them combined is the total number of outstanding shares, right? So that times the current price of the share is of course what the market capitalization is. Okay, so that's applied in the total enterprise value. When you're calculating the enterprise value, it's market capitalization plus the debt minus how much money is pulled up. It's the cash. Okay, so cash, or in other forms, how much money is pulled up from this company, that determines the value of it, right? So yeah, market capitalization, what is this? Total enterprise value. I've explained what this is. Mutual funds, so this is very similar. So mutual funds means everybody pools, so it means mutual, right? Mutual friends, mutual family. That means you're familiar, right? You're doing it together type of thing. So mutual funds means people pulled in together into these. So think of like equity investments in real estate. So things like that, those are mutual funds. Payable and receivable, this is pretty self-explanatory. Receivable means you just need to receive money, and the payable means you need to spend money on those. So it comes in the form of assets and liabilities as well, where assets make you money and then the liabilities take money away from you. So that's a very generic accounting term. Share price versus what you, so share price over what you actually make. So share price means the current trading price of the stock versus what you actually make as a ratio. So it's called a price to earnings ratio. So basically how much you make based off the current price of the share compared to like how much you actually make as a up or down of that share, right? A 10K report, this is just a SEC report. SEC means the Securities and Exchanges Commission, mainly in the US. So it's a yearly based report where every public company needs to be sharing a financial report with the SEC. Same thing applies for 10Q, which is the quarterly report, and we have the 8K report, which is the bankruptcy. There's a few other reports, but I don't really care about those. So LBO, this is very simple. Leveraged buyout. I can't spell. It's basically when you go to keep a certain amount of money from your company as collateral. So let's say you hold your current company as collateral, and then you say, hey, I'm going to put $1 million down to acquire this $10 million company in the form of debt. So I pay the $9 million debt in the form of 5-6 years. Now there's an illegal scheme here where people actually do pull out, like let's say they make the company look like it's going up in value in the temporary short term. So they fire people, they cut costs, and they pretty much they put the company's maintenance into shit, but make sure the company is generating as much profit as possible. Now, at this point, that's when the company's value is going up in price. They get the price of the company up, and then they don't really show the investors that there's debt on this company as well. And then eventually, so that investors gonna think, okay, so $10 million company valuation, that's in total enterprise value, right? So valuation, so $10 million company, you're selling it for $13 million. The next buyer thinks, okay, I'm getting a $30 million company. What he doesn't realize is the fact that it's actually $9 million in debt, right? So pretty much that's the concept. And yes, so overall the people who make the money of course make that margin in between, which is getting 10 to 13 million. Now you get a 3 million profit. You exit just like that. That's called an exit, pretty much selling it to someone else. So because that guy could do fuck all he wants. But yes, future value versus present value, I've explained what this is. Calls is just picking the phone up to call. Puts is just putting the phone down to drop it, right? So this is called long and short selling. So where long is just thinking up, we're going up, and short selling is basically we're going down. Short selling, the concept is basically I'll buy back at a discounted price later on. So as in I'm betting that this price will fall to, let's say, from $100 to $20 in the next week. So at that point, I'm short selling down to $20 where I buy back at a discount, and of course I'm going to make all the profit back going up. So again, that's the way. A margin call, I need to explain what margin call is. So margin call is when you run out of money to be in a position. Now position means like when you're in a trading position, they say in the form of an investment, or in the form of an investment is a little different, but in the form of direct trading, as in people call it quantitative trading, day trading, whatever you want to call it. So this is when you run out of money in your position. So you need to keep adding more money into not getting getting swapped out of the market, right? So it's a very terrible position. A lot of hedge funds and a lot of investment banks, and during economic crisis they actually do end up in this situation. So yes, that is very much a real thing. And yes, margin calls are awful. So yeah, fiscal is of course just government. Forecasting is just predicting the future. It's in the form of type series as well, time series modeling. So it's just basically qualitative and quantitative. So it's just like predicting the future, what's going to happen in the next 5 years based off the past 5 years, and depending on the different circumstances of things. So it's just modeling it. Modeling means just putting it in a certain machine learning model or some sort of technology computer device, and eventually getting something that's predicting the future with the AI. Primary example, right? So Yes, so GDP, this is gross domestic product. So it's just how much money is made in a certain country during a certain period of time. Okay, so that means buying and selling within for the goods and products and services that are sold within the company, whether it's money that's going out or money that's coming in. So yes, that's part of GDP. So there's this thing called nominal and the actual real GDP. So nominal means it's in the name. Okay, that means like let's say the trend is going up, right? But then like in GDP, like in the, what was it? Should I just switch to my webcam? Okay, so nominal means like it's in the name, right? So let's say we're going up in a linear regression curve, but in reality it's actually just like a up and down type of thing. So that's the real GDP. Except the nominal, you make it look like it's going straight up, no problem, like a linear regression chart, right? But the reality is like it's going down, it's going up, it's going down, it's going down, but eventually it reaches that target. So yes, that's nominal versus was it nominal versus real GDP. So yeah, time series modeling, I've explained this. Efficient market, always consistent. Yes, so efficient market assumes that there's no arbitrage difference, or there's nothing to really capitalize on. So yes, that's the fact that the market is always efficient, and that there is no such thing as capturing inefficiencies in the market where you can buy and sell, as in, you know, day trading, arbitrage, things like that. So if that was the case, then of course hedge funds would not be making so much money, right? Hedge funds, what they you know, these are quant trading firms. So hedge funds, it's a little different, but basically quant trading firms, what they do is they you know what arbitrage is, right? Little differences in price changes where you just quickly buy and sell in the span of like seconds, because there's always transactions made in the world, right? So this happens in a billion unit type of execution, where even little pennies start to add up to like the millions and billions every single day. So that's how Renaissance Technologies and all these big corporations firms end up making about crazy amount of billions at the end of the year, like I think 30-60 billion dollars at the end of the year. So yes, that's basically how it happens. And as you can see, this is their debt capital markets, equity capital markets, and then we have the whole pyramid of the investment banking. So as you can see, we have the investment banking division coverage, which is the executives, mergers and acquisitions. So this is where comparable analysis, like I said, the president is trying to merge with a certain company. So that means that's the way I remember it. President's always trying to merge with another company, so he has to do a comparable analysis. That transactional sheet is called the precedent transactional analysis, except it's spelled PRECEDNT. Okay, that's the only difference. It's the president. Okay, the president's always trying to buy and sell a company. Freaking, you get a debt from the bank, and then, you know, leverage buyout, right? LBO, and then merge with another company, get the profits out, the market capitalization up of the company. What is that? What is the equation for it? It's of course the total current trading price of the stock number times the number of total outstanding shareholders. So that's public and private combined together. Now we have a market capitalization, which in turn is going to help the total enterprise value, because the total enterprise value is calculated market capitalization plus debt minus the cash. So now we have that pretty much. Then we have the mergers and acquisitions right here, and sales and trading, equity research. So this is where asset management. So this is the lower level of it. So this is where you first start off. You go to this, you know, asset management. You know, you get what I mean. Equity research, and, you know, best companies to invest in, things like that. AI is already coming for like about here, up to here, and then yes, debt and equity capital markets. Maybe not. Mergers and acquisitions, yes, not really, because you need to really talk to people in person and be like, hey man, this company seems like a pretty good. So investment banking, essentially what it does is, it's a company A, right? Company A and company B. This looks like I'm holding two dicks, but basically company A and, okay, I'll just do this. Okay, company A and B. Basically the investment bank is the one in the middle, right? It helps company A raise money to be acquired or to merge with another company, like company B. So basically it would help the company A go live on the stock market, or raise capital, or get acquired by another company, or help another company buy another company. So things like that, where they do the comparable analysis. So they of course make these PowerPoint slides where it's like, hey, this is why this company is the best investment for you guys to acquire or merge with. And then eventually they would pitch them and then be like, hey, you know what? You know, you have seen the Wolf of Wall Street, right? That's the freaking Patrick Bateman guy. So what they do is they make these PowerPoint presentations where they pretty much convince the company A, like the executives of the company that this is a valuable investment based off real facts and data. So that's what the comparable analysis is used for. And they use a lot of different metrics, and AI is increasingly making the job easier and easier, which is in turn going to fire a lot more interns. That's kind of funny, but except it's not just interns, it's people above as well. But yeah, ROI is simple stuff. Okay, at the end of the day, what this is pretty much just the final outcome over the initial outcome. Okay, so that's final outcome over the initial outcome. Okay, so that's pretty much what this is, times 100 if you want it in a percentage. If you want it in a ratio, then just leave it as it is. So yes, that's pretty much all I got for this video. It's a quick little video, just want to recap, just want to get my brain sort of revised because I was kind of heading away from it, I would say. So yes, this is the general financial concepts that you guys also need to know. I hope this was helpful. And apart from that, just be attentive of what they're doing on a daily basis. What's the market news? What sort of loans are they getting? What sort of debt and capital are they dealing with? And yeah, that's how you make good trades even in the stock market, because you need to understand that market manipulation can be done, but the financial reports, you can't make them lie, especially if they're public news, like on the NASDAQ. Every single day it's reported and recorded, and people financially model it for 5-10 years in advance to see what kind of returns they can get in the next 5-10 years. And that's the beauty of it. So yes, that's pretty much it for this video, guys. I hope you guys enjoyed, and I'll see you guys all in my next one. Peace out.